Hello, welcome to this section where we are going to be looking at the ledger account, or what is also known as the T accounts, okay? So first, recall the accounting cycle where we record a financial transaction by passing the journal entry, okay? So in the previous section, we looked at how to pass a journal entry, that is by debiting a certain account and crediting another account, okay? So that's how we pass a journal entry. So after that, what happens? We take these journal entries and group them according to the account they affect. So that is what is going to we're going to get a ledger, okay? This ledger is basically an accounting record that you are able to classify the entries per account, okay? So for example, if we were looking at the cash account, a cash account is an example of a ledger account, okay? We are able to see the debits that happened in that account, okay? And the credits that happened in that account. So from these many financial transactions that have been recorded as we pass the journal entries. Remember, we are debiting a certain account and we are crediting another account. But now in the ledger, we are able to classify everywhere we have debited or credited cash account. We are able to get the transactions that are affecting the cash account, for example, okay? First recall how we remember the word dealer that we used to remember which accounts we debit or credit to increase them, okay? So in every business or every organization or firm, they usually have something we refer to as charts of accounts, okay? So this chart of account basically lists the accounts that they have depending on the operations of that business, okay? And these accounts are classified whether it is an expense account, whether it is an asset account, a liability account, an equity account, or revenue account, okay? So these whole accounts that are in here, for example, in under assets account, you're going to find a cash account, you're going to find inventory, you're going to find accounts receivables, okay? So this chart of account already guides the business to know these are assets accounts, these are expenses account, this is dividends, this is liabilities, equity, or revenue, okay? So when we are passing these journal entries and we have these accounts in our chart of accounts that we are debiting or crediting, in the ledger, we are able to pull, for example, a cash account and see the transactions that have affected the cash account. So basically, that is what we call as the ledger, and these accounts are what we're referring to, ledger accounts. And these ledger accounts can be classified whether they are expense account, they are assets account, liability, equity, or revenue, okay? So what does it mean when we call them T accounts, okay? Basically, a T account is a visual representation of an account. Remember, before most accounting was being done mostly on paper, not like these days when we have the accounting software. So people used to do, the accountant used to do a presentation of an account, and it has the format of T. That is where the name of T accounts, okay? So you're going to see with this T, when you draw the T, you're going to find here we have the account name, and on the left side is where we list the debits to that credit. On the other side is where we list the credits of that have happened to that account. For example, here we could have cash account, okay? And if we received money, you're going to find it on the debit side. Remember, a cash account, we debit to increase it. We debit to increase because it is an asset account. So you're going to find here, every time you receive money, it's going to be on the debit side. When you pay, that is when cash is moving out from the business, you're going to, for example, let's say we paid rent, you're going to find that is going to be on the credit side, okay? So basically, all this T account, for example, this now cash account representation is going to show us the debits that happened to that account during a certain period and the credits that happened on that same account, okay? Now, let us use these transactions to do to come up with a T account, or rather how a ledger account should look like. Okay, so for example, we have here a few transactions. Yes, it's transaction. So let us first get the journal entries that we pass to record this transaction. Then we are able to we are able to classify or group them into their respective accounts. Okay, so the first one we have, the owner invested $10,000 in cash. What is a journal entry that should be passed in that first transaction? So we are told the owner has invested $10,000 in cash. That means that the business has received cash. So what do we do to the cash account to increase it? Because we have received money, we debit that account. So we debit cash account an amount of 10,000. Okay, again there is an increase to capital. Remember, when you want to increase equity, what do? You credit. Okay, so you come here and credit, capital account as well, an amount of 10,000. So this is the journal entry you pass for the first transaction. Now let us look at the second transaction, where we are told paid office rent $2,000 in cash. $2,000 in cash. So that means you paid office rent, so you need to record the rent expense. So you will debit rent expense account, an amount of $2,000. Okay, remember the word dealer. For expenses account, to recognize an increase, we debit. That is why we are debiting. Then we're going to credit cash, because now we are paying. So cash account is reducing. Okay, cash account is reducing in this case. Okay, so we have the third transaction, where we are told that the business received cash from customers. The business received cash, let's say for example, the business has supplied goods and services to clients, and now they have paid. What will happen? Definitely the business is going to receive cash. So what are we going to do? We are going to debit cash account an amount of 4,500, and on the other hand, we are going to reduce the account receivable. The account receivable, this is the one we hold for customers who we are expecting to them to pay us. Okay, so we are going to reduce it because now they have paid us. So we are going to debit cash and credit account receivable. Let us look at the fourth transaction, where we are told the business purchased equipment for with cash, $3,000. Okay, so here that means we have received the equipment. Equipment is an asset account, remember. So we are going to debit equipment account, that is an amount of $3,000, and we are going to credit cash because we have paid in cash and the same amount of 3,000. Remember, the debits and credits will always be equal at every as every transaction happens. The debits and the credits will always be equal. Then the business again purchased additional equipment of amount 2,500. That is the same. To record, you debit the equipment account to increase it, because equipment account is an asset account. Okay, that is an amount of 2,500. Then we are going to credit cash, because remember again we are paying. So to reduce the cash account, we are going to reduce the cash account by 2,500. Then we have the sixth. Let us look at the sixth transaction. That is, the business paid warehouse rent or in cash an amount of 2,000. So we are going to debit rent expense again. Okay, rent expense again of an amount of $2,000. So 2,000. Then we are going to credit cash account, because now we are paying, that is to reduce it to 1,000. Okay, so from this we can see most of the account that is being affected, which you can use to study, is the cash account. We want now to prepare a T account for cash account, okay? A T account for cash account. So we are going to draw the T. We are going to draw the T representation, okay? So there we have it. Remember, the debits will always be on the left side, and then the credits will be on the right side, okay? So here we have debit, okay? You'll find we simplify this as DR, and this side on the as the CR, okay? And then here we are supposed also to indicate the account name, okay? So in this case, the account name here is cash account, for example, okay? So let us look at how do we record this. How does the T account for the for this month, for example, looks like? We started with a debit of cash account, an amount of 10,000. Okay, this was capital that was received. So you're going to see a representation of, let's say, here you write capital. Here we have 10,000. Okay, then the next transaction, we had a credit of cash because of paying rent. So we are going to have, how many dollars was it? This was $2,000. So $2,000. This is rent expense. This was rent expense. Now let's go to the next. Remember, this is now a creditor. This is now a credit. Now let us look at that. We have a debit where we received money from customers. That was 4,500. So here we have receipts from customers. Receipts from customers, an amount of 4,500. Then we have a cash, credit cash, that is from buying equipment 2 times. The first one was $3,000 and the second one was 2,500. Okay, so these ones will going to go on the credit side because we are paying. So here we have, this is for equipment cost. We paid to get equipment. Okay, and then we have another one of an amount of 2,500, which will also go on the credit side. Okay, equipment. Okay, equipment, for example, you could say this was equipment 01, this was equipment 02. Then we have payment of warehouse rent of $2,000. Again, that's another credit to the account. That is another credit to the account. So we have $2,000 credit for another rent expense, for the warehouse. Okay, so this is now how the cash account will look like. Remember, right now we have the accounting softwares. So this one you're going to be, if you want to pull, you will be able to pull the transactions as they are, and you just filter from those transactions that have happened during a certain period. You're going to see this is the debits and these are the credits, and you're going to see the balances. Okay, so let us look at the balance for this account. So we had capital of 10,000 and we have received receipts from the client, from the customers. So we have 10,000 plus 4,500. Okay, so we are going to remember, this is a cash account and this is an asset account, and it is a normal debit account. It will always have a debit balance. If it has a credit balance, you have to check this because this is basically going to be like an overdraft. Okay, so it is going to be more of a liability balance. Okay, so here we are going to less that is 10,000 plus we add 4,500, we less 2,000, and then we less again 3,000 because these are payment out, and then we less 2,500, and then we less 2,000. Okay, so that is going to give us 5,000. So we are going to have a balance. We are going to have the account balance is going to be 5,000. Okay, but now how do you balance these accounts? how do we balance this account so that you move to the next period? How do we balance this account? So we have a balance here of 5,000, okay? To be able to balance these, you have to include here the balance carried down. There's what we call the balance carried down. So we have balance carried down, an amount of 5,000, okay? So when you do that, when you have this balance carried down on the credit side, you're going to see that the account is going to balance, okay? Let me show you. So here we're going to have this is going to total to 10,000. This is going to total to 10,000, and this side is going to total to no, this is going to be 5,000, sorry, 5,000. Actually it's going to be 14,500 when you sum, and this side is going to be 14,500. So you see the account is balanced. But now in the next period, this balance carried down will be the opening balance, on the debit side, okay? So if, for example, in this period, if we had an opening balance, if we had a balance carried down in the previous period, we could have started it with here at the top as the opening balance on the debit side, okay? So this is what we use to balance the account as at that particular point in time. Then we take that as the opening balance in the debit side, okay? So basically that is basically what we refer to as the ledger accounts, okay? So in the next section, we are going to look at more examples of these, and also we are going to understand more of how we balance the accounts, even for a liability account, okay? So I'll see you in the next section.